So if you own a rental property or thought of owning a rental property, did you know that you could actually trade up for a better income producing property without triggering capital gains?
Giddy up.
Yes, giddy up is right. When you do a 1031 exchange correctly, you can actually trade your existing rental property for another rental property or multiple rental properties that can increase your overall income situation. So today we'll cover what you have to do in order to meet the 1031 exchange requirements and the strategy behind it. I'm Harold Powell, covering all things real estate for Ventura and the surrounding communities. And if you want to be informed of new content, well, then I suggest hitting the subscribe and the bell icon to be notified of future content. Now, one of the most significant advantages of the 1031 exchange is the tax deferral. So when you sell your investment property and execute a 1031 exchange, you can defer paying the capital gains taxes that would typically be due upon the sale of the property. Instead of forking over a substantial portion of the profits to the IRS, now you can actually reinvest the entire amount, allowing your money to continue to grow. Now, this can provide a tremendous financial advantage, especially if you plan to acquire higher value properties in the future. So to take advantage of the 1031 exchange, you must adhere to certain rules. One of the key requirements is that the properties involved must be of like kind. But what does that mean? It doesn't necessarily mean they must be identical. The IRS actually is very flexible here, allowing exchanges of various types of real estate, such as residential for commercial, or an apartment, or a condo. The key element is the property needs to be an income-producing property that you are selling and buying. Next are the replacement property rules. There are two common options here. Number one is the 3 property rule. You can identify up to 3 properties that are equal or greater than the sold property in total. Number 2 is the 200% rule, identifying any number of properties as long as their combined value doesn't exceed 200% of your sold property and is, again, equal or greater than the sold. The other important aspect is that you need to have a loan amount that's equal or greater than the loan amount that you are currently carrying on your sold property. Now, if you didn't have that loan, you would have to bring in cash to replace that amount. So, as an example, if you had a loan of $200,000 on your sold property, you'll need to carry $200,000 or more loan or bring in cash for that amount. Now, also be aware this amount can be spread over one or multiple properties. So let's discuss the timing rules. There are 2 timing issues to be aware of. Number 1, within 45 days of selling your initial property, you must identify potential replacement properties. So 45 days from the close of escrow, you'll need to have identified the property or properties. Now, you can actually be out looking at properties in the meantime before you even sell your initial property. Number 2 is you must close on the replacement property or properties within 180 days from the sale of your original property. This is actually really helpful if you end up buying new construction that can often take months to complete. So it can also be helpful if you need to give your seller additional time to find his or her replacement property. Now, the other critical element of the 1031 exchange is a qualified intermediary. Without a qualified intermediary, well, you'd have to pay capital gains. And think of them as a middleman. They're holding on to the sale proceeds from your initial property in a trust account until you're ready to close on your replacement property. Then, once you're ready to close on your replacement property, they will forward the proceeds from the trust account to the closing escrow company. Now, the reason this is necessary is because the IRS prohibits you from touching or receiving the funds into your account. Otherwise, you risk disqualifying the exchange and having to pay the entire capital gains amount, which would be a bummer. Lastly, the other critical element is having a real estate professional that is knowledgeable about the 1031 exchange process. They'll be able to guide you through the process as well as locate a qualified intermediary. Now, we said at the beginning you need to reinvest the entire net proceeds in order to do a tax-free exchange. But you do have the option to do a partial exchange. Now, in a partial exchange, you can receive some proceeds or even decide to buy a purchase price that's lower in price so that we didn't have a mortgage? Well, in both of these cases, you'd actually have to pay tax on the portion of money received or the amount of debt relief gained in this type of transaction. So let's answer the question, why does an investor consider a 1031 exchange? Well, I find it's actually very useful to look at properties like a bank that gives you, let's say, a rate of return. And let's say Bank A, which is where your money currently resides in, nets you about $60,000 a year profit. Now, if you move your money over to Bank B, it'll generate about $90,000 a year. So the question is, would you consider moving it from Bank A to Bank B? And if so, you would do a 1031 exchange to defer that gain. Now, really, how is this possible? Well, there's a few factors to understanding how this works in terms of a strategy. One of the amazing features of a rental property is that you don't find in any other asset class, like stocks or bonds, is that rental properties have what we call a 4-pillar return. So what are the 4 pillars? Well, number 1 is cash flow. It's the net income you receive after expenses. Number 2 is appreciation. The value of the property goes up with inflation and demand. Number 3 is mortgage amortization. Every month, the principal gets paid down through the rents received. Number 4, depreciation. You can actually depreciate the property, which lowers your taxable income on the property. So these 4 pillars increase in value as you increase the number of properties or units you own. As an example, I've had clients trade their single-family home into 7 units, and they were able to double their cash flow, increase their yearly appreciation, as well as mortgage amortization and depreciation. So the 1031 exchange strategy allows you to use a rental property that has a large equity position and trade up into a property that can maximize all 4 pillars. So if you found this video helpful, leave a comment below or give us a thumbs up, and thanks for watching.